Hello, my friends. Today is July 8th. My name is Joseph, and this is Markets Weekly. This week, we're going to be markets focused, and we're going to talk about three things. First, we got to talk about the global surge in bond yields, with the 10-year US Treasury now above 4%. Secondly, we'll talk about whether or not the top is in for the US equity markets for this year. And lastly, we're going to talk a bit about the currency markets because there have been some big moves against the dollar this week. Okay, starting with the bond market. Now, if you followed me for any length of time, then you know that my global macro view for the next decade is a steady rise in yields. My belief is that we have a structural, fundamental regime change in how the world works, and the bond bull market that has been kicking around for the past few decades is over. And just last week, recall I made this comment.
And they might be forced to catch up a bit. So, I know they penciled in two more rate hikes by the end of this year. I think there's upside risk to that. And I think from what I'm watching the price action this past week, there's a little bit of indication that the bond market is becoming to realize that the Fed doesn't have things under control, and we might see yields kind of steadily move up again. It looks like they've been consolidating. But as you guys, if you follow me enough, you know that my view is that yields are going to trend higher for these coming years, and we should be above 4% by the end of the year.
Now, fast forward to today. This past week, we saw the US 10-year yield jump across 4% and stay there for a couple sessions. Now, the proximate cause for that rise is the ADP jobs report. The ADP is a giant payroll processing company. So if you work for a company in the US, your company will usually pay you through a vendor that processes those payments. A very big such payroll processing company is called ADP. And because of their size in the US economy, they have a pretty good grasp of how the US job market is performing. And so they produce a monthly report where they estimate how many jobs the US economy created. The expectation was that ADP would say, we created about 200,000 jobs. But ADP actually reported the creation of 500,000 jobs, which is an enormous beat. Now, the bond market took one look at that and just kind of freaked out, and yields soared higher. Now, a couple days afterwards, we got the real non-farm payroll report on Friday, and it actually seemed to disappoint a little bit, where the amount of jobs created was just a little bit more than 200,000, which is a bit less than expectations. The bond market, at first kind of gave back a little bit of those gains. The bond yields first retreated a bit, but afterwards, the 10-year still settled above 4%. Now, that's what happened in the US. If you zoom out a bit, you'll also notice that bond yields in other countries also surged. In the UK, if you recall, last year, there was a little bit of a panic in the UK gilt market where the longer dated UK gilts soared higher amid low liquidity and amid some fundamental factors like the beginning of Bank of England conducting QT and very, very large spending plans by the UK government. Well, the 10-year UK gilt yields are now above the peaks of last year and seemingly continue to trend higher. What's happening there is very high inflation and an economy performing better than expected, and of course, the Bank of England continuing to raise rates. Now, if we look at Canada, who also had their job report last week, again, their job reports were above expectations, showing that the economy is doing fine, which of course implies that the Bank of Canada will continue hiking, and so their yields are going higher as well. So all that happened last week. Now let's zoom out a little bit more and look at the context where all this is happening. The context is that over the past few months, there's been a lot of people, and you can see this in social media, who have been saying time and time again that we are in a recession, we're going to be in a recession, and so forth. And those people have been buying bonds. I have some work from my blog post titled Back to 2019 that shows that a lot of the real money managers, let's say the pension funds, insurance companies, and let's say endowments and so forth, have probably been increasing their allocation to fixed income, to bonds. So this trade that the world is going into recession, so we got to buy bonds because one, growth was slowing, two, central bankers are going to cut rates, has been a very consensus trade, and it's been absolutely, totally, completely wrong. The US economy, by all accounts, is doing fine, and not just in the US, in many other countries as well. So if you were buying bonds thinking that inflation would come down, growth would slow, central banks would cut rates, well, you got to rethink that whole thing. And that rethink is happening right now. And so we see global bond yields rising. From my personal perspective, I believe that the US 10-year yield will continue to trend higher, and the highs are not in yet for this year. One thing I would also note is that the non-farm payroll report in the US seemed to be disappointing a little bit because the amount of jobs created was not as much as the headline would suggest. But I'd also point out that the wages also accelerated. Now, so you can read this in a couple ways. Is it that the demand for labor in the US economy is declining, suggesting that the US economy is cooling? Or is it that we're running out of people to hire? And so naturally, if you have less people to hire, you can't build as many jobs, you can't create as many jobs, and also the cost of labor is going to increase, basically a shortage of labor. So that's an interesting question that I'll write about in my blog this week. And if you believe that yields are going to trend higher, as I do, then you actually have to also think about the other major markets, which brings us to our next topic. Is the top in for US equity markets? And my belief is that yes, I think the top is in for the US equity markets. Frankly, as I've been saying over the past, few weeks, my perception is of what happened over the past few weeks is that because many people were thinking that we were going into a recession, well, the recession trade is actually very standard for big money. It's to buy bonds, yes, of course, Fed cut rates, but also, of course, to buy stocks because, over the past few decades, the relationship between rate cuts and stock prices going higher, especially big tech, has been strong, and so that's been the trade over the past few months, and that kind of got ahead of itself, it seems, because the tech stocks just go higher and higher, and in addition to this classic recession trade, we also had a lot of excitement involving AI. Now, it seems like that the indexes seem to be encountering some resistance. That is to say, they're losing a bit momentum. And if you have yields continuing to go higher, I think it's going to be more difficult for the equity markets to continue to march higher. There's a couple ways to think about the relationship between bond yields and equity markets. One, you have classic old school fundamental valuation people who are becoming increasingly rare, who will look at, let's say, cash flow or have some kind of model and say, well, I have this forecast for the cash flow of a company, but I have to discount that by interest rates. If interest rates are rising, then of course, when I discount that back into my DCF model, the valuation has to go lower. That's classic, and that's a classic view and not one that I pay attention to. What I find more interesting is that when you have bond yields go higher, well, you're going to have more people who want to buy bonds. And if you are an investor that holds a balanced portfolio, let's say 60-40 or something like that, bond yields going higher, I'm having losses on my bond portfolio. In order to maintain my 60-40 allocation, well, I got to sell some stocks and rebalance into bonds. And that mechanically means lower equity prices, since people are selling equities and taking the money to buy bonds to maintain their portfolio allocation. And some other indicators that I look at are other markets that have seemingly been leading the charge higher, and that is the Japanese stock market index. Now, if you've been paying attention to the Nikkei, which is Japan's big stock market index, you'll notice that it's been rocketing higher. Just a couple stories for that. One is that there's a lot of foreign investors pouring in. Warren Buffett notably seemed to have confidence in the Japanese market. But you also note that even as central banks across the world have been raising rates, the Bank of Japan basically has been standing put. Again, if you have very loose monetary policy, high inflation, then that's pretty good for financial assets. And so the Nikkei has been on a tear. But if you will also notice over the past couple of weeks, it's been losing momentum and it's been gradually declining. And in line with that, the Japanese yen has also been strengthening. Now, these two asset classes, the yen and the Nikkei, seem to have been leaders on this risk-on movement over the past few months, and they're lagging right now. So again, that's another caution. So you got higher yields, you got the leaders kind of faltering a bit. So from my perspective, it would make sense that at the very least, we'd have some notable pullback in the US equity markets. I'm not saying that we're going to have some kind of large crash, but it doesn't really make sense for us to continue to go higher. At the very least, I would say that we would digest a bit. So I would have a lot of caution there, especially since sentiment has also been very ebullient. Now, the last thing we'll talk about this week is currency markets. Now, I saw a very interesting reaction to the most recent non-farm payrolls. That is to say, the dollar sold off pretty aggressively. So global bond yields soared, equity markets kind of corrected a bit, and the dollar sold off aggressively. So if you look at dollar against euro, you can see euro USD inching towards 1.1. You can see the dollar against pound also dollar selling off, pound inching towards 1.3. So I find that to be surprising for a couple reasons. One, of course, if the US economy is strengthening, or at least stronger than expected, you'd expect the Fed to continue to hike rates or at least not cut rates, which the market is increasingly understanding. So all things equal, I would have expected the dollar to strengthen. And secondly, when I look at the relative strength of the US economy against, let's say, the Eurozone and the UK, it does seem like the US economy is much stronger. So one possibility for US dollar weakness could have been that the expectation that rate hikes would be more aggressive in those other countries. And that could be the case, especially in the case of the UK, where the market seems to be pricing short-term rates as high as 6.5%, which is comfortably higher than what the Fed is probably going to go. But I'd also note, though, that it's not, when you're talking about currencies, short-term interest rate differentials matter, but also, the damage it does to one's economy. Now, as interest rates go higher, they're not going to have the same impact on every economy because every economy is structured differently. In the US, some of the things that make the US economy very resilient to interest rates is, of course, that our mortgages are 30 years and fixed. So when the Fed hikes to 5 or 6%, most people are not going to feel that. So it's not going to have a big impact. And of course, because we are the reserve currency, when our government is engaging in tremendous fiscal spending, which we are right now, it doesn't have, so people continue to be willing to hold our debt. And so it doesn't have as big an impact on our yields as other countries. For example, remember last year, the UK government announced big deficit spending and the UK gilt market basically imploded. Now, at the same time, if you're looking for countries like in the UK, which has a lot of shorter dated mortgages, or in the Eurozone, where some countries have lots of short dated mortgages, that really puts a constraint as to how high you can raise interest rates. And so if you're thinking that inflation is a global problem, then my expectation would be that even if those other countries raise rates aggressively, they won't really have to stay there very long because soon it'll be very effective. Whereas in the US, they really do have to stay higher for longer to get the same impact. So when I see that the dollar is selling off of good US economic data, I think that's not the right reaction. So my expectation would be for that to revert. I think in my personal view is that the dollar actually strengthens from here on as we become clear that the US economy is fine, rates have to stay higher for longer, and that rates can stay higher for longer in the US. Okay, so that's all I've prepared for today. Hope you found it useful. If you like what I'm producing, please remember to like and subscribe. If you're interested in hearing my latest thoughts, check out my blog at fedguide.com. And of course, if you're interested in taking courses on macro markets, I have a series called Central Banking 101 I have a website called Central Banking 101 where I have a course called Markets 101 where I teach you about various macro asset classes. It is basically the same course that I helped teach when I was at the Fed training our junior traders. All right, that's all for today. Thanks so much.